Just the average American will pay $533,000 in just one of 59 taxes most of us pay every year. That's income tax in their lifetime. So if you're a married couple, double, that's $1.1 million an average couple is going to pay in just income tax, let alone taxes on dividends, interest income, and taxes on capital gains and Medicare and all these other taxes that we get hit with. So as people step into retirement, I believe it is absolutely critical they understand what these taxes are going to look like now and the likelihood of that they'll change in the future.
Welcome to Redefine Retirement with Ryan Wheless, powered by Allied Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Welcome to Redefine Retirement with Ryan Wheless. Today I'm joined by David Brooks, co-founder and president of Retire Smart. I've known David for a long time. He's got decades of experience helping clients across the country, specializing in taxes and retirement planning. In a time when headlines are filled with tax proposals, Social Security questions, and market uncertainty, David brings a practical perspective on how retirees can cut through the noise and focus on what really matters. David, welcome to the show. David, let's talk about taxes, right? I'm a big believer that taxes will be the largest expense anyone has once they, in retirement, right? Maybe even pre-retirement, by the way. And I think it's gonna be a larger expense in healthcare than healthcare. And I know you spend a lot of time talking about taxes. So tell me why tax planning would be important for somebody who's either saving for retirement or into retirement and then actually retired.
Well, I can tell you the reason I became such a tax guru, if you will, is personal pain. I had two major run-ins with that three-letter agency that likes to collect dollars from us entrepreneurs out there. I was a successful restaurateur. I ran the number one Domino's pizza in the world. I was 19 years old, and I earned about $140,000. This is 1987, by the way. That's a lot of money to get paid as a 19-year-old.
That's a lot of money, especially running a Domino's pizza.
Yeah, but it was really cool. Domino's had this process. They paid you $300 a week. $15,000 was your salary to be what they called a store president once you got promoted to it. But 20% of the P&L. So it was like you're a shareholder. You're a 1/5 owner. And so you did the P&L every fourth Sunday, 13 fiscal periods a year. So you start to learn how accounting works, right? You paid attention to the line items, not just running the operations, and then you raise sales. Now, I happen to have the store about a mile outside of Disney World's doors in Orlando, Florida. And I got really smart once I was handed those keys. I took the store from doing about $14,000 to over $40,000 a week in sales by going to all the hotels and giving the hotel operators, all the front desk, free pizza anytime they wanted, as long as they're at work. And they couldn't believe it. But we're the only one on property. And then we could go door hang coupons on the doors. And every night about 8 o'clock, when everybody gets back from the parks, from Disney, they're hungry, the kids want something, Domino's pizza, fast and easy. So we flourished in running sales. Anyway, long story short, that one got me addicted to being an entrepreneur. And I ended up opening up my own restaurant, had 4 of them, sold them for 7 figures in the late 90s, but did not get great tax advice. And so I ended up owing about 5 years later, I got a bill for almost $100 and some thousand of taxes that I thought I'd already paid. So that was kind of the eye opener for me. And I'd already been into this industry at that time for multiple years. And I had to kind of wipe out my savings to go pay out this bill. And so for the last 22 years, I've made it my mission to understand the tax code. And you're right, Ryan, it is a bigger expense than healthcare. In fact, the average American, just average, and most of the clients you and I deal with are certainly on the other side of average because they're the ones that have been blessed and lucky enough to save and accumulate a nest egg. But just the average American will pay $533,000 in just one of 59 taxes most of us pay every year. That's income tax in their lifetime. So if you're a married couple, double, that's $1.1 million an average couple is going to pay in just income tax, let alone taxes on dividends, interest income, and taxes on capital gains and Medicare and all these other taxes that we get hit with. So as people step into retirement, I believe it is absolutely critical they understand what these taxes are going to look like now and the likelihood of that they'll change in the future. And again, if you don't study history, we're doomed to repeat it. We've only had income tax 112 years, right? We are 113 years now. The first 138 years of the country, most prosperous nation on earth, we didn't have income tax. People are like, well, how do we do that? How do we fund the government? And then they get surprised when you tell them, well, it was this thing called tariffs, a dirty word right now, right?
That's right.
And so And again, I'm not necessarily for tariffs and keeping the income tax rates where they are. If we're going to swap them as our President Trump, and full disclosure, I voted for him. Doesn't do everything I like. I'm a libertarian by trade, if you will. I'm an independent voter. These parties don't suit my needs, but I really pay attention to the political environment simply because I want to know what the outcome is for my clients. And I tell my clients, because I have clients all over the political spectrum, I don't care about the party or the person. I care about the policy. And what is that policy going to do or likely do to change in the future? And right now we are in historically low tax rates. And if you think that this bill is permanent, that we just passed July 4th, there's just no way. I mean, just do the math. And we have data back it up. University of Pennsylvania, Wharton School of Finance says tax rates across the board should go up 40% by the end of this decade. That's just 5 years away. Stanford University basically did the same math. The CBO has done the same math. So we're just a 1 or 2 election cycles away from higher tax rates. That's reality.
Yeah, it is reality, David. And when you're retiring today, you have election cycles you face every 2 years.
Yep.
And nothing on the Hill is permanent. We've got Becky Schwansberg as a guest on the podcast from Stonewood Financial. She's been a lobbyist on the Hill for tax.
She was just here. Actually, we do a speaker series every year. Yeah. She was our guest Monday night. We had 300 of our clients at a venue. She was just here Monday night this week, and she crushed it with her talk. And Becky's been a friend for years. Becky's fantastic. And she's what we call the expert on legislative risk, right? And that's the problem we face. She's worked on the Hill. She's worked in the White House. The way these guys appropriate stuff, and you pointed out, like Don Bacon, who's retiring here, he's our House of Representatives from my district. I consider him a friend. I've gotten to know him pretty well, but he's retiring. So now he can start to talk out the other side of his mouth because he's not going to face re-election. And it's amazing how they change their tune the minute they're not going to face re-election. But that's the sad part is these elections. And of course, I think term limits would quickly solve that. Go there, get stuff done, and get out of there, right? But anyway,
I agree with that, and it should be a hardship to be there, not a windfall, right? I mean,
absolutely, yeah. And I'm all for. There's bipartisan support right now. They can't trade stocks, or at least at the very least should be in a blind trust. Hire someone like you or I. Hey, we'll manage your assets based on a risk score. You won't know what we're doing till you're out of office. I mean, that is not hard to do, right?
Well, it shouldn't be the motivating factor for sure. I think we totally agree on that. The other thing that's really interesting to me is that I think people hear, these tax cuts are now made permanent. And to me, David, it gives people the turtle pace mindset that, with these tax cuts being permanent, I can kick the can down the road a little bit, and I don't have to worry about this so much. It's not so much something that's should be on the forefront and something I should be worried about right now. What are your thoughts on that?
Well, I can tell you from serving, we have almost 1,000 households right here and we're based in Omaha, Nebraska, that we serve. We had a client, unfortunately, just pass away last week when they came in, and we're usually one of the first calls other than make their family because we have everything for them. But one of the things that we are so grateful to be able to do when we lose a client, and I've lost 5 or 6 this year. I mean, that's just the reality of the business we're in. But if we don't do the work we do, a la Roth conversions early in retirement and getting dollars out of those qualified accounts, we end up with a really painful realization of the widow or widower's penalty, where people that think they can kick the can down the road, well, that's fine if you're married and you've got $1.5 million in your 401k. I mean, that's pretty regular today, right? And if we don't get those dollars moved across the aisle, the RMD, according to AARP, it's a great thing that we kicked it out to 75 for anybody that hasn't really gotten there yet, born after 1960. It's really not. They are going to, this is by my math, 41% more in taxes they'll pay in their lifetime on those required minimum distributions because the account's going to grow so much bigger and they're so much older. So the number we have to pool is so much bigger, pushing them into higher tax brackets. And not only that, do we pay more income tax in a higher marginal bracket, then we get on IRMAA, right? The income-related monthly adjusted amount, the penalties, we call them success penalties on Medicare. And this is what blows people away. And we talk about it all the time. You may take one RMD from one spouse's large IRA and create 8 taxes, depending on what state you're in. Now, you are in the beautiful freedom state down there of Texas. You don't have an income tax. Up here, we do. And many of our clients have to pay state income taxes. And some states here, we just got rid of it this year. Social Security used to pay state income tax as well. So you would take an IRA distribution and it would push you over the line. Now you're paying Med B, IRMAA penalty, D penalty on one spouse, then those penalties on the other spouse, then you're paying the state income tax, and both your Social Security's got more dollars in the tax bucket, right? And some people hit an AMT tax, right? And so 8 potential taxes on one distribution because someone thought, oh, it's not going to affect you. You're only in the 12% tax bracket now. But we have tons of clients, Ryan, here that live retired happily on $70,000, $80,000, $90,000, but they have $2.5 million in these qualified accounts. And they don't understand, no, you're going to have $400,000 in forced, we call it forced income. We're going to force you to take it. The government has been waiting patiently, and actuarial by design, they need this money back. And I already know you know these numbers, but it's 14,300 people average a day are coming onto the entitlement system, right? Social Security, et cetera, turning 65 right now. We're at the peak year of the baby boomers. And the government knows that Social Security and Medicare, all those things are, they tell you in the letters, Social Security is going to have to make an 18% benefit cut in 2033, and Medicare trust fund runs out in 2036. I mean, they print it out clear as day. So these guys, the politicians, have been kicking this stuff down the road. So we want to explain to people, look, they're going to have to do means testing. So if you have a certain asset level, your RMD may be subject to a surtax, right? Not on income, but it just might be on your asset level. There's all kinds of things in Congress, in the committee. I don't have the books in front of me, but I can get them to you. But Congress publishes this stuff. Here's all our ideas. And it's 2 fat booklets full of all the ways that they think they can, what we call hidden tax, backdoor tax, the Medicare penalties, et cetera, that nobody is preparing, at least most people are not being prepared for. And that's why I'm so passionate to connect with advisors like you around the country. Iron sharpens iron. We all meet up at conferences and we train each other, and we're helping people understand these hidden potential taxes that, and let's face it, 37 trillion in debt. Now, the Federal Reserve, you and I are recording this on the day the Federal Reserve just cut rates, literally
just
as we
cut
started,
rates moments
right?
ago. Yeah.
Yep. And they announced a couple more cuts, which is what we anticipate, and probably 3 more cuts next year. So that's about 150 basis points. They're going to move rates down over the next 15, 18 months. At least that's what the markets are foretelling us. Well, that's great on the front end, but that's not how you finance government debt. Typically, you finance it on long trajectories. So what'll be interesting to see is how the market really reacts, the bond market in particular, on the longer end of that yield curve. Because if it gets like the 1980s and inflation gets out of control and that long end spikes up, that could wreak some havoc on people's, their portfolios. Both bonds and equities could be hammered pretty good in that situation.
Well, that's the funny thing is that people think the Fed actually sets interest rates, and it doesn't. They can set an overnight lending rate, right?
They shut the overnight rate, right? What banks
the bond
build
market,
balance their sheets. Yep, the bond market. And just look
rates
around the globe, right? All yields on the long end of the curve, 25 years or longer. Any country, any sovereign debt out there of a G20 nation, the yield has been drifting up all year. That is the world's investors, right? And that's institution, pension funds, school teachers. Their money is being invested heavily in these bonds. And if rates go the wrong way, those bonds could lose 30, 40, 50% in value when you need to liquidate them. So again, there's so much risk out there for clients that are, and we've been, let's face it, it's been a while since we've had a real bear market. We had a COVID, right, snap down, rebounded awfully quickly. We had the tariff tantrum, really fast rebound. But I've been doing this 4 bear markets in my career. I've been doing this a long time. Went through the .com. That was 3 consecutive years of double-digit losses. I always ask clients,
3 times in market history,
Yeah. Well, do you remember what that was like? Because that $1.4 million you have today, that could be 600,000. And if you're already taking income, it could be even less, right? If you're pulling off 5% or that or so, you could really get yourself in trouble if you do not have an actively allocated portfolio that is diversified, has some principal protection in it, has some, you really, it's just so much different than people think that, oh yeah, just buy the, S&P 500 and hang on. I don't think that math really jives,
Well, it doesn't. And the thing is, if you want to go down that path, just look up the drawdown of the S&P 500 index, and it's over 57%, which happened in 08, 09. And ask yourself, could you live with that? If you were literally watching the $1 million you had saved to finance the lifestyle you want to live in retirement, and you're watching it go down, to $570,000, $400,000, whatever it was, can you deal with that? Can you stay committed to that long term? And I don't know anybody who can.
No, and that's just it. Nobody really holds through that. But even if you did have the fortitude and the stomach to do that, that's one thing to do it when you were younger, right? So when 08 and 09 happened, right? I was in my 30s, right? So I could weather the storm, so to speak. I could keep adding to the accounts. I could dollar cost average through, income, going into 401ks, et cetera. And I had time on my side. But if you're already actively in retirement or just about to step in, and you're going to start pulling that income out, the math gets extremely dangerous. In fact, if you'd have done the old 4% rule that a financial advisor Benjamin created in 1987, in fact, he just put a paper out this past week. He said he adjusted the 4.7 rule, and I actually refuted that right here on my show last week on my radio show. I said that I don't follow that rule. If you would have followed the 4% rule and just done the S&P, Ryan, and retired January 1st, 2000, you ran out of money in 2023. And, right. So if you're only going to be around 23 years, if you want to make that gamble, have at it.
Well, if you go back and look at it, I mean, the S&P was at 1550 in 2000, about 2000 and a half.
Yeah.
And then it went down to 6.6 and 7, I think it was, in 02. And then we went back up to 1550 in October of 07, and then plummeted in 08, 09, and then got back to 1550. I think it was 14 years in 2014, I think is when it got back to 1550. That's a
basically the lost decade, which people have forgotten. Now it's the forgotten decade. We used to call it the lost decade, right?
But think about this. If your life expectancy retirement is 30 years and you have 14 years of no return, you just live 40% of retirement with no return on your money. I don't know any portfolio, any withdrawal rate, other than a zero withdrawal rate, but how are you living, right? That can sustain that. It's just not possible. Let's go back to something for a second. We're talking about the RMD age, right? And we call that the tax time bomb, right? Because you've saved all this money in these accounts all these years. You get to retirement. You need, once you leave work, you're no longer putting money in your 401k. That's a pay cut, right? Excuse me. It's a pay raise. It's a cost cut and a pay raise or expense reduction. You're no longer paying the 7.65% payroll tax. Likely you don't have a mortgage anymore. Okay. And so if you're making $100,000 a year and you're spending, putting $20,000 a year into a 401k, putting $20,000 a year into a mortgage and, paying the payroll tax
at work.
But I mean, you're basically going to be able to live in retirement off $50,000 less in income to maintain the same lifestyle, right? In retirement. So what that means is you need a lower distribution rate or a lower amount of income, and your portfolio doesn't have to work as hard, especially when you consider Social Security income, right? So what happens is these accounts, these IRAs, continue to drift higher and higher and higher and higher and higher. And as those values grow, we get out there in the future, and I think the first RMD is about 3.71% of your account balance, right? You have to withdraw that, but it goes up next year and the year after and so on. So that's what we call the tax time bomb, right? Because now all of a sudden at age 75, you got to start pulling this money out and it's forced income. Here's what's interesting to me, though. A lot of people think that's a good thing. Like, oh, they saved us. They helped us because it was the Secure Act, which we call the Setting Americans Up for Income Tax Act, right? But here's what's interesting. When your children inherit those IRAs and those 401ks, they have 10 years left or 10 years to withdraw the money. So they've got to take it all out over a 10-year period.
And this happens in their peak earning years for them. They're going to be late 50s, early 60s when it happens, right?
It's exactly right. And so you took time to put your kids through school, did without, maybe even could have had a better quality of lifestyle in retirement if you didn't do that, but you did. Now your kid's out doing well, and you're going to dump $1 million IRA on top of their income over the next 10 years. Yeah. I mean, 37% of your IRA is going to go back to, and that's if your kid's married, by the way. If they're single, even more than that, is going to go to Uncle Sam. And it's really interesting. My dad just retired from United Airlines as a 737 captain. And we had a conversation recently. And I said, hey, Dad, we're going to start doing Roth conversions. And he's like, well, what are those? I'm like, and I said, more importantly, I'm going to pay the tax on them. He's like, whoa. You're going to pay the tax on these conversions for me? I'm like, no, I'm paying it for me at your tax rate, Bob.
Yeah.
So let's talk about that a little bit. I mean, what's happening there? Why did Congress do that? Was it to set us up for less tax, more tax? How do we fight that?
Well, it was done twofold to get early adopters to do Roth conversions, because you are paying the tax now, so we get revenue into the government's coffers. But it also actuarially sets us up to get a massive amount of revenue starting in around 2032, which ironically is when, right, the government starts to run out of money in those trust funds, right? Social Security, et cetera, we've talked about. So actually, by design, they believe that they will be able to backfill as baby boomers expire. It's just the reality. Right now, we have it's a little over 6,000 baby boomers a day are passing away, unfortunately. 4,100 of them are married. And so what happens is that single provider is now getting bumped, as we talked about earlier, up the bracket, because now they're a single filer versus a joint. They're having to take faster distributions out, having to pay more in tax, and then the kids end up inheriting that IRA, as you said. and they get up in a higher tax bracket. I mean, all this is designed. And by the way, Congress doesn't really write our tax code. It's written at Cornell. It has been since 1912. And we kind of go to the law school, the tax center at Cornell, and frame out. And they do. They literally target how they want to tax somebody. How would you do it if you're trying to do this? Of course, with AI, you can do this yourself. You can literally talk. And that's how the AMT tax came about, which is the alternative minimum tax. That was a tax created to tax 236 specific individuals. And of course, before 2017, the first round of what we call the Trump tax cuts, over 4 million people paid that tax that year. So again, once they start a tax, they really don't claw it back, and there's no such thing as a temporary tax.
Yeah, it's interesting. And with $37 trillion in debt and rapidly climbing and rates where they are, not even going to be able to afford to pay the interest on the debt. I mean, they've got to get tax revenue from somewhere. And, I think there's $37 trillion in IRAs right now. I think they're around that number.
Well, boomers control between IRAs, all assets and businesses, about $59 trillion in net worth. And so while right now we have a massive estate tax exemption at $15 million a person, so that was made permanent here on July 4th this year, we know that is not likely to stick around either. And so, I mean, I'm old enough, Ryan, to be in this business. It was $625,000 was the exemption when I started, and anything over that, and a good account for an advisor at that time, about $200,000-$300,000 was a pretty nice size account that you would land when I was at Payne Weber, and that was a pretty decent account. But then you had their home that was worth maybe $150,000 back then. That'd be $700,000 house today. And they had life insurance. And we can even talk about that. The life insurance benefits are paid out tax-free. But if you own the policy, it's calculated as part of your estate or inheritance tax. And I live in Nebraska, one of just 6 states that still imposes such a tax. We have an inheritance tax here in
a state level.
Yeah, at the state level.
Yeah.
And
not
then
just federal level.
The state I was born in Baltimore, Maryland. Baltimore's the only state that charges an inheritance tax and an estate tax at the state level. So in other words, they tax the beneficiary, they tax the estate, then after what's distributed out, they tax the beneficiary as well. And people don't think these things through. I have family all over Maryland, and I try to explain this to them. Simple things you can do. Create an irrevocable life insurance trust. Couple $100, you can get it done, and just move your ownership of your life policy you already have in place over there, just to make sure that it's not calculated part of these taxes, because governments, federal and state, are hungry for dollars. You live in a wonderful state that does not have income tax, right? So what's creeped up in your state is property taxes. We have that issue here, right? We don't have the population. We don't even have 2 million people in the state of Nebraska. So we have all 3 legs of that tax stool. We have a sales tax, we have an income tax, and we have property tax. And our property taxes are ridiculously high percentage-wise. My house is I live on a nice house on a golf course. Now, don't freak out, because I know where you live. But I live there. You could buy my house for about $650,000, and it's a 5,000 square foot house on a golf course. Nice, big, beautiful deck. That, like in Orlando where I used to live, that would be about $3 million. But my property taxes are $15,000 plus. That's crazy, right? To own my own home that I paid like less than $400,000 for a few years ago. And so you have to rent your own house basically in property taxes. And so states are trying to figure this stuff out. How do we get more revenue? And of course, if we go through a recession, we're starting to see the housing market correct. I try to explain to people housing, it's normal. It goes longer cycles than the stock market, but it does correct. But your local government never seems to care, right? They don't take your valuation down 30% if your house went down. So seniors need to be looking out for all the taxes they pay. And this is just a sidebar, but one of the things I always advocate for my retired clients, hey, you've got some freedom in your schedule now. One of the things I think you might enjoy doing is showing up to the county commissioner meetings or the school board as an advocate for how they spend your dollars. Because what happens, they usually have 2 or 3 people come before those boards, and they get to make these decisions involving hundreds of millions of dollars of school board bonds and road and infrastructure bonds without really any input from the community. But they post in the paper, they hold their public meetings. So I advocate for seniors to be advocates for our community and show up. I mean, I don't have any kids in the school district I live in, but my school board gets about $10,900 of my property tax bill every year. And I mean, you could that's more than I paid for college tuition, right, in the 80s. So, I mean, that's a lot of money to educate a kid from just one house in the marketplace. But anyway.
Well, so especially considering that you keep paying it when your kid's no longer in school.
Yeah, exactly. So I just think, and listen, I believe I should pay my fair share. I believe that we need services from the government. So I always joke taxation is theft. I don't mind paying a portion of what I provide if I'm going to get reasonable services back. I want the federal government to have a defense for our country. I certainly want to have reasonable laws. I want to have roads I can drive on. I want to have clean water. So I don't mind. But the problem is the way our system is done. No one is there advocating on behalf of the taxpayer for stewardship of those monies. You know, you and I are fiduciaries for our clients, basically, and we have to be good stewards of their money. That's what we're trying to help them do. Why isn't the government held to that standard? Yet these people go up for re-election every 2 years. They say they're going to do this, and then they end up doing that, and it drives me nuts.
Yeah, it's the way it's been for a long time. Let's spend a minute on this, David. Tell me this: when we have clients and prospective clients call us and go, Ryan, you know, my current advisor at Ed Jones or Ray J or the bank or wherever, they're not having these conversations about taxes with me. Why are they not having these conversations with me, yet you are?
Well, you know, it's interesting is I've been teaching advisors for 20 years now, you know, how to talk tax. In fact, we've accelerated that. So we bring advisors into Omaha a couple of times a year and do these live trainings. And I've taught over 600 on stage on how to do tax planning. And the problem is, one, they're not trained, and two, their compliance departments and legal departments don't want to step over that line. I mean, at our office, we have a full tax division. I have CPAs on staff. So we have the capabilities to do it. But most of these, and again, I'm not bashing into firms. I have friends at every firm you can name on Wall Street, from Morgan Stanley and Merrill Lynch, Goldman, you know, Stifel, all the regionals you mentioned earlier. Just because I've been in this business for almost 3 decades, you end up finding friends. But it's just not, their companies don't allow it. It's not the advisor's fault. It's the company they work for typically. And I always tell people, look, if you're going to go shop at the big box store, you're going to get the big box answer. And it's usually going to be very cookie cutter. You know, you're limited in the selection. When you go out to the independent space, right? And that's why, and people don't have to work with my firm and my market or yours and yours. We try to educate. We do a ton of educational events for clients. All we want them to do is be good stewards of their money. Enough of them, we know enough clients will find value in what we do and hire us, that we can have a nice business that grows. But we want people to understand how to find a good independent-based advisor that is not beholden to the mothership, right? Not being forced to have only these lineup of products or whatever, which is why 401ks are terrible investments today. The idea and the execution are so different. Government regulated that, you got to be fiduciaries on these 401ks for your employees. So what did companies do? They abdicated that, what's called the 338, right? Who's the fiduciary on the plan, to a sponsor. So now these companies, big companies, T. Rowe Price and Power, do that for him, but they're not going to send somebody on site and do the education. So they send a 5-question questionnaire. Like, is that really risk management, right? Is that really assessing someone's understanding or quality? And then they cram them into 12, 15 funds on average is all they have available. These target date funds, they're garbage, absolute garbage. So what happens is the intention was great, right? The legislators had great intention. Hey, we want to get lower prices for our consumer. We want to help them save better. We want to help them get educated. But because of the mass way it's delivered, the exact opposite is what really happens. So that's why we advocate for people that are still actively working. Hey, reach out to a retirement-specific planner. If you're within a decade of retirement, find a retirement-centric independent advisor in your marketplace that can help you at least start to allocate those things right. Because you're 10 years out, you can probably still keep your foot on the gas pretty good. But you're within 3 to 5 years. As we mentioned earlier, there have been 4 major drawdowns, over 35% in the markets the last 2 decades alone. Do you want to go through that, or could you handle it? You know, we sometimes call it about, you know, what is your risk score? What risk can you handle? I call it risk capacity. How much of that can you really handle before you'll kind of lose it and, you know, capitulate and then do the wrong thing and then put all your money under the mattress and not grow any of it, and then you get eaten up by taxation and inflation. So you really have to be proactive in your planning and work with somebody who gets you. And so I just think it's so important that we have more advocates like you and I talking on the radio, YouTube, wherever it may be in the marketplace, because we don't need everybody to walk in our door, right? And we're not a fit for everyone in our marketplace. And I'm sure you find the same there, but we are happy to help people that want the help.
Yeah, it's an interesting thing, bud, because, you know, people have been taught to save money in these tax-infested retirement accounts, and they come to us and they're so lopsided with every dollar coming out of these accounts to finance their lifestyle and retirement, subject to taxes. And I actually had a guy reach out to us after watching one of the YouTube's videos that we did, and he was arguing with me that his 401k was not taxable. And I was like, okay, it is, but I think where he was hung up was the 10% early withdrawal penalty. Yes, that goes away at 59.5 years of age, but you are still going to pay income tax on every single dollar that comes out of that account, right? And if you leave a widow behind, she's going to pay even more tax. Okay.
Well,
And then your Social Security is taxable, and the people understand that part of it too. And I think that's why what we do with providing the education that we do is just so important.
Well, the fallacy too is, and I get challenged because I do education at local colleges. We actually have a huge classroom in our facility here. And so sometimes people are like, well, you're making me pay the tax now, so I'm losing out on the opportunity of that growth. And that is a complete myth. Let me give you an example. Let's just say you have a client who has $100,000 in a qualified account, IRA, 401k, doesn't matter. And for argument's sake today, we'll just place them in the 24% tax bracket. So if they called you up and said, hey, Ryan, I'm buying a, motor home or whatever for retirement, send me the $100,000 out. And of course you got to withhold the tax. So you're going to withhold 24% or 24 grand. So the client has $76,000 spendable today in that account. And I kind of explained to him, well, what if we move it to the Roth and do the same thing? We withhold the 24,000. I put 76,000 in the Roth. I said, where do you think you lost? He goes, well, now that Roth is growing, but there's only 76,000. I said, all right, let's run that math out. Let's say we leave the 100,000 in your account. And let's just say over the 15 years, whatever investment we pick, it doubles, let's say twice. So $100,000 after about 8 years is $200,000, another 8 years. So we went like 16 years retirement, $200,000 is now $400,000. If you could still take it out at 24% tax bracket, you couldn't. It'd be a higher tax bracket if you took $400,000 out. But if you could, how much is that on 400,000? Well, that's what is that? $112,000 or excuse me, $96,000, right? So they would have basically $304,000 that they could walk away with and spend. Well, if we had the 76th in the Roth account over here and doubled it twice, you end up at the exact same place. You do not lose. You can never lose doing a Roth conversion unless somehow tax rates were significantly lower in your future. And that is highly, highly unlikely. The best case scenario is you do the Roth conversions while we have these historical low rates. And then in the future, those tax rates went up. Your friend who didn't do the conversion will be taking those dollars out, not at 24%, but probably 35%. I don't know what it'll be, but that's what the math tells us. This person over here is taking out all of it tax-free because they paid the tax on the seed versus the harvest. And so we just show people with math. It's just math and logic that we can solve their problems. And on top of that, most clients that we deal with, Ryan, they end up, frankly, have more money than they'll spend. They don't really run out of money. The problem is they're going to have too much forced income. We call them Midwest millionaires right here. People work hard. They come in, about 80% of my clients walk in 100% debt-free. They just, they've worked hard. They've paid the mortgage off. They're not laden with debt. I had a practice in Florida for many years, worked in South Florida, Vero Beach, dealt with very, very high net clients, but they loved to live on leverage, right? They had mortgages, $4 million house with a $3.8 million mortgage. So they didn't really have any net worth there, right?
And were rich.
Yeah. And they thought they were rich, right? But they didn't have.
For sure, they were. Yeah.
But here it's very realistic. Somebody will retire somewhere between $90,000 and $120,000 is the income ask for a married couple here. And they can have a wonderful life in Nebraska with that. The problem is they've saved and deferred all those dollars, and then they start getting $60,000 or $70,000 RMDs from all their accounts with their Social Security and maybe a pension. One was a school teacher. Now they're $200,000 in taxable income, and they don't want it or need it. And so by doing this, we give them the freedom. That's one of the reasons I call a Roth IRA a freedom account. Once we've completed the Roth conversions, which we don't blow up in 1 year, we typically do it over about 6 to 8 years on average. Then if you want a distribution, take it. If not, the money keeps compounding tax-free. And the late, great Charlie Munger, Berkshire Hathaway, is literally just down the street here from my office, right? He said the only thing you want to do with compounding interest is not interrupt it, right?
That's
and
right.
Once you get these dollars into these tax-free accounts like a Roth, that's its beauty, is you can roll it forever until and if you don't spend it, which a lot of our clients don't, your kids inherit that. Now, they still have to get it out at the end of the 10 years you mentioned earlier, Ryan, but there's no distribution each year.
That's right.
And they get it all out tax-free. So another 10 years is probably another double. I mean, it's just massive opportunity to create estate wealth, generational wealth with just a few moves. And then, of course, what we do is we add a couple of extra strategies to even reduce the tax liability on those conversions.
Which is why I am at age 48 and I'm paying the Roth conversion tax on my dad's IRA and 401k.
And I love that line, by the way.
Right?
No, I'm paying at your rate, Dad, so because I can inherit it at my. I mean, I didn't. I'm going to use it on my radio show next week. By the way,
mom
that is
and
a
him,
nugget I'm stealing from you, bro. That is fantastic.
You're welcome to it. And my mom and him, their income's $100,000 a year. Okay, and you and I both know that with the new Trump tax cuts, the new over 65 exemptions, trying to eliminate taxes on Social Security, didn't get it done yet. Hopefully, he does.
Yep.
which is still subject to change, by the way, in the future. It can be undone.
Yep.
But you could have like $154,000, I think, in top line revenue and still be in the 12% tax bracket, but you're actually closer to a 10% effective tax bracket. Right.
Yeah.
So if you're spending $100,000 a year, you can convert $54,000 a year from IRA money to Roth IRA money up until age 75 at the tax range that stays the same. And you've built up a $540,000 Roth IRA and it costs you a 10% tax hit to do it.
Yeah.
What are we doing?
I mean, it's just, and that's just it. So, but people have to be shown the math, right? And that's the problem when they go even into, one of those big box retail financial shops we talked about earlier, and the advisor's like, okay, hey, I went and saw this class or this seminar and they showed us this kind of math. I'm like, can we do this here? And he's like, yeah, you got to write a check for, 62,000 or whatever the Roth convert. And they're like, whoa. And so, I developed my own software. We actually licensed it a couple hundred offices across the country now, but about 14 years of it. So about 6 years ago, I launched this software quietly, but so we can show clients not only the math on the conversions, the true effective rate, right? And obviously there's some assumptions in there, the Social Security COLAs, things like that, but also what the net benefit is to their children and for them. And, I just say, what year do you want me to have you, end of plan, right? Expire. And I will show you what the value is, what the difference is. And the longer you live, the bigger those tax savings really become. And that's the other thing is longevity risk is a very real thing that a lot of people, baby boomers sometimes kind of, I won't be around that long, yet they are, right? And I mean, we have a few clients in their 90s, have 2 clients over 100. And that's going to become the norm in our business, right?
My grandfather's 95, Dave. He's in Asheville, North Carolina. We just went to go see him. And he's in a home. And he is, the oldest person in the home is 109.
Wow.
109 and still there and still pretty sharp, has faculties, whole 9 yards and 109. Do you think that person, when they sat down and talked to a financial advisor, ever thought they would live to be 109?
No.
Or lived like they'd be 109 as far as spending goes and investing goes?
So imagine if that person retired at 60, they are now 59 years into retirement, right? Did they get their fair share out of Social Security? I think they did okay.
For sure. They also paid a lot of tax on the way too, right?
Yes, they did. Yeah. And that's the problem if nobody did the planning. And again, the older clients were guilty more so than today's generation, but we had a lot of boomers, that the older half of the boomers, that turned on Social Security as soon as they were able. Oh, I'm scared it won't be there. And that's usually incorrect math, at least in our opinion, as well. Now, if there's mitigating circumstances, health issues, that might make sense. But, one of the things I think we can kind of flip this on Social Security is not only, and by the way, I watched one of your videos. You have some great educational content. You went through what we call that Midwest millionaire case. It was like $3 million asset case. They had like a $7,000 annuity. They had 2 nice Social Securities, and you were recommending, hey, wait, because if we lose one spouse, and the husband was really worried about the wife in the video you did. So I thought you did an excellent job in one of your episodes. And it's exactly that. We want the higher earner, if we can in our plan, to wait actually to 70 unless they really need that income, because that's the check that's going to stick around, right? The survivor gets that check. And that's massively important. That also gives you more time to do things like Roth conversions before you create an extra taxable layer of income. So it's putting all these pieces together that can really drive an amazing plan for the clients that they can see incredible value. And then the benefit is you don't necessarily have to take as much risk if you don't want to. But once you get dollars in the Roth, if you want us to take risk, that's where we want to take it. Because if you hit a home run, you get to keep it all.
That's right. The thing is, too, man, when it comes to taxes, is I have a saying that the more tax you pay, the more income you have to take out of your retirement accounts to maintain the same level standard of living, right? The more income you have to take out, the higher rate of return you need.
Yep.
And the higher rate of return you need comes with
the drawdown risk you face, the bigger risk you're taking. Absolutely.
That's exactly right. The bigger the risk you take, the bigger income you need, the higher percentage you need of your portfolio. You have to take more risk to get it. You're subject yourself to a larger drawdown. And so taxes have this major, like a pachinko ball, if you will, effect way down deep into your retirement plan that you may not even see. And that's why I love what we do, because, we decode this stuff for the average person out there who just doesn't know what they don't know.
Well, I will tell you what we do too is we help people with large assets, liquidate them. We have a lot of farmland around where we live here, and it's generational wealth. But most of the folks today don't actually farm, right? Their uncle's still the farmer, but it's fewer and fewer, unfortunately, people. But most of these are second or third generation landowners. But land has skyrocketed in value. A 640 acre farm, pretty common for our clients to have one, is now $15,000 an acre. You have a $10-11 million asset, and people don't realize when we talk about the estate inheritance tax problems. And so, like, well, if we sell it, what can we do? And, that's where we do some of our advanced analytics and advanced training and planning for these clients, where we can mitigate or reduce them by using additional strategies. The other thing we can do with clients with these large IRAs, like that $3 million case I was talking about in your education, is you simply bring in for accredited investors, which they would be at that level, understanding that there's certain alternatives that have incentives in the tax code that will reduce one's tax liability. Oil and gas, solar, et cetera. These things are meant to get economic activity where the government wants it. And for that, you may get some form of tax incentive. And that can be used to chip away at some of the tax that would be paid on those larger conversions when they come in. So it's not just one, there's no secret sauce, one strategy. It's putting all those together, and then you're compounding the effect and doing a Roth conversion at a significant discount. And I think clients are yearning for that information, but as you said, they're just not going to get that if they walk into the, everyday, green and gold or blue and silver big box retailer,
for sure. The other aspect of that too, David, is if you work for one of those firms, a lot of them are publicly traded. And if you say, hey, Miss Jones, you've got $1 million IRA here, let's convert over to Roth IRA, the entire thing, and pay, 30% in taxes. Well, if you do that and you take the money out of the IRA account, guess what? That firm now has 30% less assets to generate fees and commissions on, and is therefore going to take a 30% haircut to their bottom line.
Yeah,
go have that conversation with your go have that conversation with your shareholders, though, right?
Yeah. We talk about clients. Look, when we're telling you to do this conversion, we're withholding the tax, and we've sent it. That we're sending money that we would have billed on, and we're no longer billing you on those assets. But we firmly believe it is the right thing to do for you and your family, and that's upholding to our obligation as fiduciaries to our clients. So I think that's critical. You bring a great point. Those big publicly traded companies, man, they don't want to give up a third of that asset. That would Wall Street would whack them pretty good.
Yeah, they wouldn't like it at all. And I think that's why a lot of companies as well aren't advocates for getting tax advice. And folks, listen, taxes again will be highly likely your biggest expense. And today, as we said, we're in the third best tax regime in history, being as far as where rates are, the third best. How on earth do we maintain the third best tax regime in history? Yet we're I'm going to call it $38 trillion in debt. I think we're still printing a trillion. So yeah. If not in 5 minutes, right? But we're literally printing another $1 trillion in debt every 120 days in this country. All right, guys and gals, you can't have tax rates that low and debt that high, and the government gets the money to pay its bills from taxes, and this sustained. It just can't happen. And so you have the ability to take advantage and act on this stuff now. But if you can hear this stuff off you all you want to. If you're going to reach out to me or reach out to Dave or somebody to get help, just
get help. But start to do the math. I cannot. I constantly tell people, have somebody run some numbers for you, show you what those proposals look like, and then be the captain skeptic. I always tell people, if you're a skeptic, fine. Hit us with your bullet points or whatever it may be. Like the opportunity cost, I've already proven is a myth. That's just done with math. But like I said, the only way doing things like Roth conversions is wrong is if somehow you were to go to a lower tax bracket. Now, I will tell you from our research, 4% of Americans, that's a reality for. And they're typically not our clients, because those folks have literally, they walk into retirement, they have such little amount saved. It's usually just a few $1,000s in savings account. And then Social Security is their only income other than a few pennies of interest income in a year. And of course, that was the one blessing for seniors, right? Interest rates skyrocketed up a couple of years ago. We finally got to get paid at least a decent rate on a money market or a certificate of deposit or certificate of disappointment, as I always call them, because you then have to pay taxes on them, right? And inflation. And what was your real return? Maybe 1%. And so, but these folks, they just don't have the resources that most of our clients do. So those are the people that do go to the lower tax bracket. But most of our clients not only go up one tax bracket. If you're a married couple, the realistic projections show that every married couple, one of them, usually the survivor, obviously, is going to go up not one but two tax brackets before they expire. And that's by design, the widow and widower's benefit, because they've saved all that money in the wrong tax bucket, that tax deferred bucket. And, I'll just give you a strategy we help clients with too is, you want to, when they come in with more assets than they need, and this is very common, especially they come from a Merrill Lynch or a Fisher Investments, right? They'll have them in a very heavy stock portfolio. And granted, it's done phenomenal. The growth has been fantastic. But they're just set in this model. It's kind of a set it and forget it, no active management. And then when they ask the broker why, he's like, well, we don't want to create any tax issues. Where I say, number one, they should be doing like things like tax loss harvesting. There's ways to do that with the portfolio that you can reduce risk along the way without really creating any taxation. And two, if you could tax loss harvest, we do this commonly. We'll set up the Roth conversion plan. But I noticed their portfolio, they have $2 million in a trust account kicking off $75,000 or $80,000 in dividend income. And we ask them, are you spending that income? Well, no. Do you need it? No. Well, why is your portfolio set up to give it to you? So we may tax loss harvest $500,000 and put it into what's called a non-qualified annuity, right? And it's just a fixed annuity that's going to either index to the market or earn a fixed rate of return. And right now you can get over 5% in these things guaranteed. And I'm like, hey, we're just going to park this over here for a short term, 5 years or something. That gives us now, I don't have 40 or 50,000 in taxable income hitting their tax sheet every year. That's 40 or 50,000 more I can convert to the Roths to the same tax bill they're already paying. So over the next 5 years, that's $250,000 I've moved without paying one dime in additional taxes than what they're paying today. And again, that's what stepping back and doing a true plan on all these different asset classes can really help these clients understand, holy cow. And we literally have software we can show you like, hey, your lifetime tax savings is estimated to be $283,000 by following this plan. I mean, what's that mean for you? How many more vacations is that if I can get you to take them? And of course, I spend more time.
Yeah. One of my most watched videos on my YouTube channel was, hey, how to save $350,000 in taxes in retirement. And it's mind boggling. And, and Dave's right. I mean, people, they set their portfolio up and in retirement here, how to get income. Well, dividends, right? Yeah. And just by moving the chess pieces around the board a little bit, we can take that, get you the same dividend yield on that $500,000 as you're saying there, get it in a tax deferred bucket, shield it from taxes for the next 5 years, and then just pile on the Roth conversion stuff. But people just don't see this stuff. They see what they've known from traditional financial wisdom or conventional financial wisdom to be the truth. But the thing is tax rates and the tax situation and the government debt was not where it was back then when all these books were written and all this conventional financial wisdom came about. And it's just changed dramatically today, and your strategy better change to keep up with it.
I wholeheartedly agree there. And that's just it too, there's what we call the efficient market theory, right? I believe the market does get efficient, not instantly though, with the product innovation, right? So one of the things we have to cover, and we can maybe cover it in the back end of this if we have time today, but long-term care, right? Traditional long-term care, the products that I would place for clients, 25 years ago, very different than the products, how the world is innovated. And now clients can get long-term care coverage sometimes as a rider on a life insurance policy they may already own, right? Or it can be innovative inside of like that annuity that's already given that guaranteed 5%, where there may be a free rider if they want to use it. But there's innovation is all over the place. And so the other innovation is like in the 1980s, most people were not going to go pick individual stocks. So they were investing in investment vehicles called mutual funds, right? Very, very popular. Well, the transition has been happening for the last 40 years, much more into what's called exchange traded funds or ETFs, much more tax efficient vehicles to utilize because they don't have, and people understand this, inside their IRAs, their mutual funds are paying taxes. And I explained to you, you're paying taxes in your IRA. What are you talking about? I don't have to pay taxes till I take your money out. Let me show you your fund. Just pull their ticker up and show them the capital gain distribution. The share price is knocked down. This is typically going to happen the last week of November, the first 2 weeks of December every year. And we call that tax drag. And then there's cash drag because the mutual funds are required by prospectus to keep some of that money in cash for daily redemptions. And so using the right investment vehicles can create efficiency in the portfolio. Again, it's small moves, but if you could get an extra 60 or 80 basis points of return by using a more efficient vehicle that's the same exact underlying investments in it, what does that do to your portfolio's return over the next 20 years? And on a $500,000 portfolio, it's about $60,000. So, I mean, it's significant.
Well, could you use an extra $60,000 to go on vacations over the next 30 years?
That's exactly what we do. And so we show people tax savings from tax loss harvesting, using more efficient investment vehicles, from using Roth conversions, from using their charitable gifting. So, one of the things I use personally every year is a DAF, a donor advised fund. I love stocks personally. I like to buy stocks, but I don't like paying taxes. You probably figured it out if you've been watching this for a while. So every year, and my wife and I are blessed that we start to write some pretty big charitable checks now. And our company gives away 6 figures plus every year. We give away over 6 figures plus personally every year. And it's a blessing to be able to do that. But I don't just write the check out of my checkbook, right? What I do is I put money in the market. I buy stocks. I own things like NVIDIA. These things are great. But if I put $100,000 in January and at the end of the year last year, it was worth about $130,000, we had an amazing market. if I was going to give away $100,000 to charity right before Christmas to kick out all my charitable donations, I don't write the check for 100. I put the check in my brokerage account. I transfer $100,000 of highly appreciated stock to my donor advised fund. It gets sold in there. No capital gains taxes paid. And the money goes out to the charity the following week. Charity gets the same money. I get the same exact write-off, but now I raise the cost basis on all those stocks from 100 to 130,000, what have you. And so I can continue to do that over and over and over. And this is a great strategy, by the way. You're in the Houston marketplace, right? So you have a lot of oil and gas folks, right? So I'm sure you got plenty of people come in with Exxon or Chevron stock, right, through RSUs. Great way to help them diversify risk without paying any tax. Here it's Berkshire Hathaway, right? Oracle of Omaha is just down the street. We have a lot of clients that own Berkshire Hathaway and they don't want to sell it. We get it. So we just put it over in an account and use it for that strategy. Hey, we're going to buy it again tomorrow, but we're going to donate so you never pay tax if you decide to sell it. Again, you don't know what you don't know. I say it all the time. And there's so many incentives. In fact, there's over 1,700 incentives in the tax code today to reduce or lower somebody's tax bill. But the likelihood they're going to find them, slim and none.
That's it. Go to your CPA. Just file the return. Just pay the tax. Yeah, that's
even entrepreneurs, right? If you work, we work with a lot of entrepreneurs. We do exit planning. And that's one of my fortes is helping business owners, do their transition. We have 4 CEPAs in the building, which is Certified Exit Planning Advisors. And when we ask them what kind of tax advice their current CPA's been proactive, well, go buy another truck. That's the advice, and no fair. It's back to 100% depreciation. So you buy a truck this year, you can write 100% of that thing off. But you had to still write the $80,000 check for that truck, right? And so how big a tax strategy is that? And so it's getting down to the brass tacks of what is it that you're looking for and the type of person you're getting advice from. And, we always kind of joke about it. It's like we cover 5 key areas. Now, we acronym SMART, and I know you've got your plan, right? And we do the same thing. We just we're good marketers, so we certainly name our niche things. But typically when they're coming from another firm, they're only getting 1 or 2 of those services. They're getting some form of risk setup originally, how they allocated, and they're getting investment selection. And so I'm like, well, how'd you get comfortable paying a full fee when you're only getting about 30 or 40% of the work? So and that's kind of eye-opening for clients when they sit back and think about that. And then we add on the tax savings we give them. I was like, did you really have to pay us? So, but it's so important people understand how critical understanding taxes, because look, if tax rates stay if this permanent really is permanent, hey, that's fantastic. So the worst you would do from doing a Roth conversion is pay the same tax, but have the freedom not to have a forced distribution via a required minimum distribution in the future. So you get freedom on your side. You would also guarantee yourself those RMDs would never trigger taxes for the Medicare penalties, IRMAA, we talked about earlier. So what's the worst that can happen if you do Roth conversions, at least filling up the current tax bucket you're already in? There's zero reason not to do that, right?
Especially if you're in that 10% bracket, there's no reason to not. I mean, it's crazy because you can take a Roth IRA conversion, pay 10% tax on it today, right?
Yep.
But when you do that conversion, you pay the tax. Cool, it's 10%. But in the future, if you wait to kick the can down the road until you're 70, 75, the tax you're going to pay the distribution could be 25, 30, 37, and who knows where tax rates are by then. It's mind boggling.
Well, I just tell people, if you don't learn from history, you're doomed to repeat it, right? So since 1913, we originally had income tax in 1913. It was 3 brackets. It was 3, 5, and 7. It was very simple. But the brackets have gone as high as 94% in 1944. But the average top marginal tax bracket, which is 37 today, is 63.8. The mean tax bracket for middle-income Americans, that middle quintile, and Becky speaks about that. Becky Swanberg, we mentioned earlier, the middle quintile is really how they design the tax code, is 24.8% effective rate. Right now, the middle quintile, the effective rate's about 16%, right? So if we just go back to average, that's a 50% increase in your effective tax rate, 16 to 24.
The 10% becomes 22%. And that's where a lot of people you and I serve that wind up income-wise just because they saved well, they've done well, paid off their debt, that sort of thing. So, well, Dave, I can't thank you enough, my friend. It's been a great conversation. Let's do this again soon, for sure.
Absolutely. My pleasure, man. Good to see you again. And
the encyclopedia of tax knowledge.
Well, thanks for doing this with us. And, we'll look forward to watching on your show.
All right, brother. Be well. We'll see you soon. Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.